Hello, ladies and gentlemen. Welcome to Triple N Media. I am NIK NIKAM. Today we are going to look at ABC correction waves in Elliott waveforms. Apply that to Triple Q technical analysis so that we will know when to avoid getting into a market and when to enter a market as we are getting out of the correction waves. Generally speaking, the Elliott wave principle is based on the psychology of millions of people investing on the stock based on the technical analysis and also based on the fundamentals as hedge fund managers, money managers and institutions invest in millions of stocks. They have done all the research. They know which direction the market is going. So we just tag on to them and then make a few bucks here and there. But the Elliott wave principle is based on the fact that first we have impulse waves, namely 1, 3, and 5. And we have two correction waves known as 2 and 4. Today I'm going to focus on these corrections because that's where most people are going to get burnt. You make an entry, these corrections waves are short, they abruptly change directions and they are unpredictable. They can be protracted for long periods of time, what they call in the stock market as consolidation. Actually, it's a correction. Okay, let us continue with our basic understanding of how the correction works. And if you understand how the correction works, the impulse waves take care of themselves. If you know when to get out of the market, and if you know when to get out of the market, and if you know when to get into the market, then the impulse waves will take you through the profit lines. So this is what I call profit lines, and this is what I call headache lines. All right. A basic correction after an impulse wave is a flat A, B, C. That's the basic concept of a correction. This correction could be anywhere from 38.1% or 50% or 61% of wave 1. But if you're coming from a mega trend and then you see a reversal change like after a debacle, it is not uncommon for the correction to trace as much as 81 to 89% of the first wave, which is 1. So this is the simplest form of correction. And of course, after I finish with these introductory slides, I'm going to actually take you into Triple Q chart and show you some of these examples. The A wave is a phi wave, just like the regular impulse wave. The C wave is more impulsive than A wave, so that it moves very abruptly. So that's an indication that you're dealing maybe with a C wave, whereas B, too much unpredictable. The B wave itself is divided into multiple parts. Here is the B wave. And this is the typical formation of a B wave. The B wave itself has A, B, C, and C. And following that, you're going to see another C. Since we have two C's coming next to each other, you're going to see some violent movement in the prices and you think, oh, the correction is over, let's jump in. And immediately you see it just takes a nosedive and goes beyond where A ended. That's why it is exceedingly important to understand the concept of B waves. B waves are very complex in that it can have multiple formations, which I'm going to cover in a minute. A waves are fairly simple. You have the 5-wave movement, 1, 2, 3, 4, 5. C is the same thing, but it is much more violent, 1, 2, 3, 4, 5. But the B wave is like meandering. You have no idea when the hell this B wave is going to end. And that's what you have to learn to understand, because if you understand that you're in a B wave, then you have to know when to get into the market and when to get out. I said this is a flat correction, A, B, C. That's one form of correction. And then we have a more vigorous correction, which is a B, C, but the B is less than 38 to 40% of A wave. As a result, we get a zigzag correction. The zigzag corrections are usually seen when there is a lot of pressure for selling the stocks. And the zigzag corrections generally go beyond 38%, maybe close to 50 or 61% of the previous wave. And most of these complex corrections, you see them in wave 4, which comes after a very brisk and steep movement of the third wave. That's why a lot of people trade only wave 3. So they wait for the wave 1 to come, then they wait for the formation of the ABC, and when it cuts through the trend lines, which I'm going to talk in a minute, then they get into the market here, and as soon as they see the beginning of the fourth wave, they get out. So this is the most profitable period to get into the market. That tells you why it is important to understand the correction waves, especially wave 2 and wave 4, and that will give you signals as when to get into the market and when to get out of the market. Wave 5 can be very short. It can be long too. Again, it's not predictable. Wave 3 is the most predictable, impulsive wave. So we need to understand that the best time to get into the market is to wait for wave 1 to form, then it consolidate, and then you enter into wave 3 and get out before you get hurt. Under certain circumstances, when there is not a whole lot of good news, when there is not a whole lot of data coming, the market can go just sideways, like ding, 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 ding. It's going nowhere. It's consolidating. That's what they call it. And it can be like this. A, B, C, X, A, B, C, X, A, B, C. You can have up to 2 X's. Yeah, but there's some people who have more than 2 X's. Well, that's a different story altogether. We are talking about Elliott waves. So let's leave all my X's live in Texas. That doesn't apply to the Elliott waves here. All right. And another form of correction is called triangle. A triangle is basically A, B, C, D, E. You got it? A, B, C, D, E, and it forms a triangle. And the good thing about the triangle is if you can clearly identify the triangle and draw the trend lines, that tells you when to get into wave 3 or wave 5. See, there's a lot of technical information available from the corrections, and it will help you to get prepared to get into the most lucrative impulsive waves, namely wave 3 and maybe wave 1 or 5. Okay, that is a triangle. This is like a downward triangle. We can have a horizontal triangle, or we can have an uptrending triangle. So it's just the direction of the triangle. And most of the time in a triangle, the wave C is the longest one. So that's why you draw a trend line between A and E. Same way here, B and D. And when you bring these two triangles, and if it breaks to the upside, you are going up. If it goes to the downside, our calculations are wrong. So let's go back and look at the calculations again. Here is another form of triangle which has like A, B, C, D, E, F, G. Now I know my A, B, C, D. Oh, I'm sorry. I got carried away here. Anyway, this is like a 7-wave, 1, 2, 3, 4, 5, 6, 7-wave correction. Correction is a correction, but we need to know what direction it is going and how long it's going to go, how low it's going to go, and when is the change in the direction, because that's the most important thing. That's why we draw these trend lines and follow them. If these points are hitting the trend line and coming back and going up, that means you are in the correction. Let me repeat it again. If you draw the trend line from here to here, and if you draw the trend line from here to here, the rest of it is going to fall within these trend lines according to the triangle principles. If it goes beyond that, our calculations are not correct, but when it goes beyond, it may be starting a new wave. So that's a tip off. That's basically some concepts about corrections. Let's look at the real chart here. Okay, let's go for a 2-year chart here. I start off with some easy ones and then we go to, okay, here we have a correction here. I'm going to expand on this one if I can, I don't know. Okay, here we have a typical flat correction more or less. A, B, C. But that's not the end of it. Here we have a B, C. Then we have a B, C, D, E. I'm just saying it. C. So basically A, complex B and C. Then we have a B, C here. So that is a correction. Now when we get a new wave, we get a wave 1 here. Then we have A, B, C. And then it keeps going up. Now let's look at here as what happened right after March stock market collapse. It came down here. This was the lowest one. This is A, B, C, and C. Like that. Then we have A, B, C after a brisk move. Then we have another correction here, A, B, C. As you can see, A occurs quite briskly and C is the same way, whereas B is always longer than any wave in the correction. Here's A, B, C, and C, and then it keeps going. So if we understand these corrections, let's look on a little smaller time scale here. Okay, so here we have 1, 2, 3, 4, 5. This is 2. Okay, let's draw it again. 1, 2, 3, 4, 5. Okay, so that is wave 3. Now here we have 4. A, B, C, C. That is 4. And this is 5. So this is wave number 1. All right. Now this is A, B, C, and C. So that is B. So this was A. So this was B. Now we have the C, which is similar to this one. So then we have 1, 2, 3, 4, 5. So that is the correction. And again, we had the new wave which started here, which came as 1. Then it kind of zigzagged here. That was probably either 2 or this may be A, B, C, and it was kind of zigzagging today. So that is in a nutshell about looking at corrections, and the best thing is to see when you exit out of a correction so that you can enter the market. Thank you so much, and hope